Hi, everyone. My name is Mike Taravella, the value add investor. And today I'm here to discuss partnerships. What are they? What do a lot of the people, when going into business, feel like? What do we need to be weary of? And then, more importantly, really going to dive into what a syndication or real estate venture looks like, so you can kind of understand the moving pieces, how to incentivize each person, and then kind of the three big takeaways to end it. So we're going to dive right in. First, we're going to discuss what a partnership is. So, big, sexy definition. A partnership is a noun, per Merriam-Webster, is a legal relation existing between two or more persons contractually associated as joint principals in a business. So really long, boring definition, but the key takeaways is that it's two or more people, could be LLCs, could be, essentially it's two or more entities or people associating together and working together, combining their time, resources, sweat equity, to form a business and to move forward in an attempt to make profit. The biggest thing I see a lot of people doing online is when they're trying to start their real estate investing journey is they get super excited. They meet someone on Facebook, they hear about an idea, and they're super gung-ho. But I think it's more important we think of when we think of these partnerships, we take a longer approach and treat it like marriage, right? So yes, I do. People get, like I said, get excited, get head over heels, fall in love with the deal, fall in love with the idea, fall in love with taking action, really making sure that they're going above and beyond. When in fact, look at the beautiful honeymoon. This is what our financial freedom is looking like. We're going to make so much money together. But as Elon Musk says, it's going into a startup is like staring into a fog storm and eating glass, right? So there's the risk of divorce, right? Splitting homes, cutting ties. There's a risk for bankruptcy. There's that risk of not being able to pay investors, not being able to pay vendors. And so when we really think about partnerships, don't do it for the Facebook, don't do it for the ego. Really, there's three main things that I think that people need to do before they say, I do. And that's that they need to know, like, and trust them. It's a very, I've seen this cliche a lot, but I really want to dive into each one of them. First, when you think of know, right? I know them. Well, what do you know? Do you know their background? Do you know their successes? Do you know their failures? Do you know everything about them? Do you know how they're going to act when push comes to shove? Because the easiest part about starting a business is day one of forming the LLC. You have the momentum, you have the drive, you have the hope, you have the dreams. You're in that honeymoon phase and everyone is excited. But when push comes to shove, how is that business partner going to act? Has this person had experience with partnerships before? Why did they fail? There's DISC assessment, Myers-Briggs. There's so much information out there to really make sure that you and your partners align. I think a big piece of it that some people don't talk about is core values. Where are they looking to go? What really drives them? Who are they doing it for? Because as any venture, if you're just doing it for the money, it's not going to work out. You have to know their long-term visions, because this could be a flash in the pan of I'm doing 3 flips and I'm done, right? It could be I'm trying to do syndications because I want to help investors. Could be my start into joining venture capital. There's so many nuances that people, when you say you know them, how much do you know them, right? Is there a referral? I've seen a lot of people get referrals, come in, and then you ask them after that referral came through and it didn't do a good job. Well, I didn't really know them that well. So it's just a lot of different moving parts that when I see people say, do you know them? do you know everything about them? Because you're getting married. You wouldn't get married to someone you met, a few days before, or someone you met at a coffee shop the next day, right? It takes a long time to build. The other two factors, like and trust them. The next one being like. Do you like them? It's fun. Can you handle them for an hour? Can you handle them for 20 hours? Can you handle a week trip with them? Because in any partnership, you're going to be spending a ton of time with them. So do yourself the favor, do themselves the favor, and don't get started. If something really irks you about them, you really don't like when they do something, but just making sure that you like doing business with them, you like spending time with them, you like working with them. Don't just work with them because they might have a lot of knowledge or expertise in an area. They drive you nuts. It will not go well. Time and time again, you really need to know that when you spend time with them, you like working with them. And also, to the last point, know where they're going so you guys are going in the same direction. And lastly, trust. I kind of hit on this in the no part, but do you trust them with every fiber of your being? The gut test is the big thing. Do you trust them leaving your wallet on the kitchen, leaving the wallet and making sure they're not snooping? Do you trust them with your money? Do you trust them to execute on what they say they're going to do? Do you trust them? Because if not, it could be disastrous, right? As long as you're playing to strengths and weaknesses, you trust them very much. They're not doing this venture for the money, this partnership for the money. It could be it could be very detrimental to you and your team. So just making sure that you trust them, you're aligned, you know everything about them, you like them, working with them, and you trust them. Because in a partnership, people are going to be pooling money. There's countless stories of people not trusting each other. And so it's really making sure that like, and trust, but go really deep in each category. I've seen a lot of ventures kind of spinning off on Facebook relationships, never meeting them, not really understanding their background. Have they had experience doing this similar business or a business? And then they're surprised when their online persona looked amazing, but then they turn around and go the other way and steal money, right? So I'm not saying you have to do background checks on everyone, but really make sure you go super deep, take the time to build the relationships, because that's how you will grow in your business ventures. So building that dream team. So this is going to be more geared towards the real estate realm. So I've built out the kind of hierarchy, and it looks a little bit different, but it's mainly because this is the chart of accountability. So we're actually going to start in the middle with our investing team. So this is generally where I've seen a lot of teams start, is that they're trying to build out this investing team. The main goal is to get the property on the right, to get this cash flow, beautiful property. So what does that team entail? First off, we're going to start with acquisitions. So this team member has to constantly go out, build broker relationships, understand the market, do their market research, make sure that they feel that this is a good, strong area with strong market factors, such as job growth, population growth. You look at Texas, you look at Florida, these strong markets that are continuing to grow, and know where that you should be and should not be to invest. They have to build rapport with brokers, owners, trying to get off-market deals. They're underwriting deals. So they're constantly, they don't necessarily have to be boots on the ground where they're on site, but they really have to know the intricacies of every market and know going in and out to see where the path of progress is and where there's true opportunity in investing in deals. Next is the investor relations side. So this team member, in commercial real estate, it's great to have the deals, but you also have to have the money, right? So when you're doing your SEC offerings, you have to have a team of investors behind you that you already know, like, and trust to come alongside with you. because there's heavy violations, there's jail time. In the world of the capital raiser trend, it's a really big piece that I think people are downplaying. So anytime you see capital raiser, there's a series of licensing that's very extensive with the government. So be wary of the capital raiser label and just look for investors. But what the investor relations role does is it markets themselves to investors, putting content out there, making sure that they know, like, and trust investors, understand their goals, making sure they understand the risk when it comes to real estate, because even though real estate's a great asset class, there are risks associated with them. Making sure that your investments align with their goals, because, for example, if you take a flipper or a wholesaler of homes and they're trying to turn around and buy and sell a house in 60 days, but you as a real estate investor that buys apartments might have a 3, 5, or even 7-year window that they're having their money tied. So it's really making sure that your investments are aligned with their goals. I speak to investors where they didn't like our investing thesis because we put debt on the property and they were looking for all unlevered offers, or they didn't like the markets we're in. And that's perfectly okay, but you have to make sure that they align with your goals for the property. So the investor relations are onboarding investors for prospective deals, but they're also walking them through the process and making sure that when you do have a deal from your acquisitions team member, that they're accepting, they're getting their documents in, they're funding the deals. We can go in more content later about what that process looks like, but I think it's super important just to make sure you have someone who's finding deals, someone's finding money. And when you're starting off, all these roles can kind of merge together, right? And the real estate in any investing firm, it's a very low, I don't want to say low capital, but there's not a ton of human capital when it comes to it in the sense of the core main team like this. And lastly is the asset management role. So what this role is, because the acquisitions and the investor relations have found a deal, the acquisitions person found a deal, the investor relations person has raised enough capital legally, and they've transacted on the deal. The asset manager is there to help craft the business plan with the team members. They're also in charge of making sure throughout the deal's life that we're hitting returns, that they're hitting key performance indicators that we'll talk about later in a different video, but they're super important to make sure the key operations are moving smoothly. So these 3 team members, when I say team members, it could be one person when you're starting off, it could be 3 people, it could be even more, right? There could be analysts on bigger teams, and the hierarchy continues, but these are the 3 main components. The acquisitions, who are finding deals, investor relations is finding the investors to help invest, and the asset management is the people that make sure the business plan is moving forward, because there are fluctuations in the market, and this is a key focus. So now that you have the team, you found the money, you found a deal, raised the money, and you have your asset management team in place, the bottom, and I call it the bottom because we treat this like a hierarchy of accountability. So this is the coveted property, right? The property management group, it doesn't, it's the layers of accountability, right? So the property management is highlighted yellow because they're generally third party or different business. With Rand Commercial Real Estate, we're vertically integrated, but many other investing groups have their own third party property management, which is fine. There's pros and cons to both, but the property management oversees and is held accountable to the day-to-day operations of running the property. So what does that entail? It entails a lot. It is the leasing, it is the maintenance, it is the capital expenditures, it's the collections when it comes to residents. It is the resident experience, making sure residents are continuing to not break leases and continuing to stay, so we have as minimal turnover as possible. And lastly, it's spending. It's the expenses, which pertain to marketing, which pertains to admin, which pertains to repairs and maintenance and renovations. Countless things. And the property management, I thank a property manager every day because their job is definitely not easy. But they are responsible for making sure that they are implementing, the property management is implementing your business plan at that property. So if anything goes wrong, the asset manager is there on weekly, monthly basis to make sure that you are moving in the right direction. So the asset management, and I don't like to see, I see a lot of content on podcasts and social media that the asset manager manages the property manager. I hate this because it's definitely not true. The asset manager collaborates with the property manager. There's been times where we as the investing team, we get into a deal, it's working great, and then the city and state raise the water bill 7%. And we can say, oh man, this is terrible. What are we going to do? How are we going to do it? I can't tell the property manager as the asset manager that, hey, the water bills are too high because there's this state and city mandate. So I collaborate with our property management team and see where we can change and reallocate our expenses to see what we can do to mitigate it. And so what we came up with is that we can charge our residents 7% more when it comes to RUBS, which is a utility bill back. So by no means as a asset manager is it you come into the property manager and tell them how to run their business. Obviously you want the income to be growing and the expenses to be going down, but I think it's important that you can tell them to the property management, they're blue in the face, hey, these expenses need to be lower, but you as the asset manager might have to reallocate and work with them and collaborate instead of manage. So we already talked. So the property manager is accountable for making the property. The investing team, mainly the asset manager, holds the property management accountable on operations. And then the big boss, the true LFA, is your passive investors. So these are the people that'll hold you as the investing team accountable because you have taken the passive investors' money to operate the business plan. So investors will definitely let you know if you're not paying them the returns that you expected. And I mean, there's communication rhythms and transparency that you have to be held accountable for and let them know. But the passive investors, if they're not getting paid, will let you know what's going on and what can we do to make it better because they've entrusted you with their capital. And when you take on anyone's money, you are a steward of their capital. You have to protect that capital if it were your own. And so it's just making sure, once again, know, like, and trust your investors. Be ethical. Don't take on people who had their last bit of money because they know you and are betting everything on you. Do it the right way and do it ethically. So if that passive investor is not getting paid, they'll keep you accountable. But if you're paying them, they'll be good to go. So I think it's important to view this as an accountability hierarchy of the property is accountable, or the property management is accountable for managing the property. The investing team holds the property management accountable, but also collaborates. And then the passive investors will hold you and your investing team accountable for it. So I think people look up to the investing team as like, all right, I'm my own boss, but really the investors are your boss and just got to make sure you're operating. So one thing I want to make sure we touch on is incentives. So I think whenever starting a new venture, business owners, whenever you're starting hiring team members, it is important to make sure that all the incentives are aligned for the long-term growth, right? So starting with property management, they are paid a property management fee, which is generally charged on a percentage of gross scheduled or gross rents. So it's just making sure that the property management team is having your building filled, making sure they're getting paid, collections are getting paid. But I think another one that we do for Rand Commercial Real Estate is that we provide bonuses on several different factors. First off is collections, especially during 2020 and 2021 COVID-19 pandemic. There's been a lot of fear with it. So it's important that we're incentivizing our property management teams to make sure that they are collecting as much rent as possible. Because of that, our team has gotten creative and helped with rental assistance programs and walking our residents through and making sure they're protected and cared for. Another bonus that we've talked about is the Net Promoter Score. And what that is the surveys you've seen everywhere, and it'll kind of spoil it, is the 2-question survey on a scale of 0 to 10. How likely would you befriend a friend or colleague to stay at one of our properties? And so when looking at this and when seeing the NPSs, a 75, which is it's your promoter percentage less your detractor, so 6 or below versus 9s and 10 scores, you take that as a percentage, subtract them, and you have a percentage. So 75 is deemed world-class, like Apple computers and their customer service. So on the property management side, we're trying to deliberate a high Net Promoter Score that they will get bonused out as well. And so that, because we've found that a high NPS score means you're taking care of your residents, you're making sure that they feel welcome, they're staying at the properties longer, which means you're saving money on renovation costs. So if people, it's just key to make sure that as a property manager, as when you take one on, they get paid monthly on their management fees, but you can also get creative and find and bonus structures such as collections, Net Promoter Scores, and other various key performance indicators that we can talk about later. But that's how their incentives are aligned. The investing team, going to start up top, they get the general partner shares. So they're generally the ones running the deal. So these are the active investors, the general partners. So they get, in our instance, we have our, historically, our GP shares represent 30% of the deal. However, they also get paid a percentage of acquisition fees and asset management fees. So the acquisitions, investor relations, and the asset manager all get a percentage of the acquisition fee, which is generally 1 to 3% of the purchase price of the property, because there's a lot of legwork on the deal. There's a lot of due diligence that goes into it. It takes at least 60 days to close on, 30 to 60 days, 30 on a very, very fast, aggressive end if you're paying cash. And it takes about 60 days if you're getting agency financing on it. So there's a lot of upfront work that goes on. So generally it's 1 to 3% on the front end. The asset management fee too is 1 to 3% I've seen for providing reporting to our passive investors and making sure we're executing on our business plan. There's a lot of time of just making sure property management meetings, pulling out reports for our investors, communicating, providing a ton of transparency. But I think these are just fees throughout the deal, but the GP shares, this promotes the long-term wealth. Generally, as your general partners, you get paid last on deals because you have to pay your limited partners first. So that's why the passive investors are on top of the hierarchy, because you have to pay them first. So the GP shares help create that long-term focus to make sure you're continuing to run the deal effectively. The property management is getting paid throughout the deal for operating the day-to-day, but you as the GP shares, you get paid less. So it's important to make sure you're continuing to play aggressive, have that longer-term vision, and making sure you're executing on your business plan day-to-day. And then on top of the hierarchy is the passive investors. Unlike the GP shares, the LP shares on our deals are 70% of the deal. So the passive investors have a higher majority. They are silent owners, but passive investors will definitely let you know, like I said, if things are going well or if things are going really poorly, and they will definitely let you know one way or the other. So because they have that majority and they don't make decisions, but like I said, you're being a steward of their capital and really helping them help grow wealth for them. And so they too are aligned with the longer term vision because they have equity in the deal, generally a majority ownership of it. And so what to help promote your deals to your investors is a preferred return. Historically, we've done 8% on our last 3 syndicated deals. And what this just means is right off the top, your limited partners your passive investors are gonna get 8% of the cash flow, net cash flows first. We have it accumulating, so if we don't hit that 8%, they're eventually getting paid. But that way, the limited partners are going to get paid first, and then there's that 70-30 split after, 70 to the passive investors. So with that preferred return, you're promoting your investors, hey, when we hit this 8%, you're getting paid first because our passive investors are first, and that's why they sit up top on the accountability hierarchy, and then you have the LP shares. So I think it's just super important to recap how everyone gets paid. If you're not in line in incentives, it's going to be disastrous if you have the short-term and long-term incentives. So the property management is getting paid by the month-to-month operations, but there's ways to help incentivize key metrics that'll help grow your business through bonuses for collections, physical vacancy or physical occupancy, net promoter score, and many other ways. Your investing team, there's an acquisition fee. That's generally 1 to 3% of the purchase price. And asset management is 1 to 3% of the equity managed. So those are those incremental fees, but really what helps align the passive investors and our investing team is the shares of equity that we have together that owns the entire property so that we long-term can cash out and make, whether it's a refinance or sale. So it's those shares. However, the GP runs the deal and has the active management versus the LP is the silent owner that is going through and making sure that they're getting paid. And usually we pay them with a preferred return on top of the split, which we can go later in a different video because it can get pretty complex on the different structures. But we just want to make sure that everyone is healthy, aligned, because in this business, nobody does things for free. It's super important. The property management has the day-to-day angry residents dealing through it. The asset management is going through trying to work with the property management on a weekly and monthly basis. And so there's just so much work that goes into this that I just want to make sure you as investors understand how each member gets paid. And so lastly, I just want to go on the dream team. Like I said, aligning incentives, right? You don't want to make sure that your property management has a very short-term narrow focus, or even your general partners, but your limited partners have that longer-term focus. So incrementally build incentives that align with it, because like I said, no one does stuff for free. And then I think another thing too is hire slow and fire fast. So if you realize quickly in this partnership it's not going the way you want, you might have to break up with that partnership. But like I said, take a long time to deliberate, make sure you understand what you're getting into. But I think you need to really understand, hire slow, build those true partnerships and those relationships and grow. And if it's cutting ties, cut them immediately. One of our properties, we had a property manager. We had collections in the 60%. We were in a hiring kind of bubble. One team member left. We needed someone. She was still available, and so we thought, hey, she ran this property before. Why not make it better? However, and we thought it was a quick band-aid, but that band-aid caused more turmoil long term because we had to invest a lot of team members we had to let go of that team member, and then we also had to invest time and resources to get the property back up. It's not performing great, but all goes back to hire slow and fire fast. And the last thing is establish rhythms and milestones. So I think when starting a partnership, I think it's incredibly important that people, when joining a partnership, understand how often they're meeting, when are you to, one, keep each other accountable, but two, just to make sure you're in constant communication. I see when people don't establish the rhythms, it could be a bother, and just making sure they're not going the right way. But I think it's super important that you establish when you're going to discuss and what you're going to discuss. And lastly, I think it's milestones. I think we at Rand have a list of metrics, not extensive, right? We have occupancy, collections, delinquency, and marketing in our budgets. So it's 5 key metrics, but how are we stacking up each week to hit those milestones? Because if you don't have rhythms, you don't have milestones, you can't keep each other accountable. So it's super important and just can be very frustrating. And the partnership might not be going as well as you want it to be. So there you have it, the dream team partnerships. What does a real estate deal look like? So if anyone has any questions, leave them in the comments, and is super excited to reach out to me at mike@miketaravella.com. And until the next video, if you find any value, like, comment, subscribe, any way to help promote our content, share it with a friend, would be much appreciated. So have a great day.